This rate cut is nothing more than a psychological push to the marketplace for the average Canadian, not paying attention to what's happening in interest rates. And they know the BOC reduced rates, but they don't really understand what impacts a variable rate and they can't qualify for more money.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
Well, ladies and gentlemen, Tiff Macklem just made most Canadians the happiest elves this side of the North Pole. There's my Christmas vacation reference. I hope you like it. I did my very best. We'll try again later. As you may have heard, on December 11th, 2024, the BOC cut rates again, unsurprisingly, depending on who you talk to, by another 0.5%. This brings down the overnight rate 1.75% off the peak since the heights earlier this year in 2024 at 5%. We're now sitting at an overnight rate of 3.25%, which in effect puts our overall prime rate with most banks at 5.45%. I can just hear people rejoicing left, right, and center. But I can also hear a whole bunch of other people who have no idea what the heck this means, and they're overly confused. So let's break this down. Remember, BOC rate change impacts variable rate mortgages and lines of credit. BOC rate change does not necessarily directly impact fixed rates. Those are primarily based on yields, the Canadian 5-year bond yields, swap rates, as we talked about with Mr. Robert McLister in a previous episode. And if you haven't checked that out and you want a better understanding of how rates are determined, you've got to go back and hit the previous episode right there where he breaks it down step by step beautifully to understand that. Now, with the U.S. numbers still higher than expected this time right now, and the Fed in the United States, which is the equivalent to the BOC, only anticipated to drop rates by 0.25%, it's a likely outcome right now that, well, we don't see any major changes on the fixed rate market. And in fact, just to fast forward a little bit here on that rate conversation, because I know that's what's on everybody's mind right now, BMO recently came out with a projection, and their feedback was, well, in short, it looks like at this point right now, fixed rates could be relatively close to what they expect to be a bottom. And as they hover in the 4 to 4.5% range for those 3 to 5 year fixed rate mortgages across the board, it appears that fixed interest rates are settling where they are. But what's interesting is based on the news of what happened today, the gap has tightened, which means that fixed rates and variable rates are closer together. And for the first time in a long time, it's really making the average Canadian start to question whether they should have taken a variable rate versus a fixed rate in the last year. More so, I think the average Canadian is not paying attention to the fact that, well, those variable rate discounts are starting to go away. Banks are not offering the same incentives to take a variable rate as they were, well, when they were as high as they were just 6 months ago. 6 months ago, we were seeing TD Bank, for example, offering discounts at prime minus 107, prime minus 117. And that was when the Bank of Canada had an overnight rate at 5% and prime was nearly 7%. So looking forward to where we're at today, we're seeing banks like TD Bank on an uninsured 30-year mortgage offering like prime minus 50, prime minus 55. And that's really the best in the market that you're seeing for an uninsured mortgage. Whereas if you have an insured loan, it's closer to prime minus 90 to prime minus 100. And this all depends on your ability to qualify. What that means basically is the banks are smart. They know that a lot of people are going variable. And so they're not giving the same discounts that they were before. But hey, let's take a step back here because we didn't really talk about what happened, why it happened, and where we're going to go next. Yay, what's going to happen in January with the next Bank of Canada announcement? Well, first and foremost, I thought it would be interesting to quote a comment by Scotiabank economist Derek Holt, where he quotes, "This was, in short, one of the most hawkish upsized cuts in the history of upsized rate cuts across global central banks. It almost had the feel of having an apology note attached to the decision." Interesting stuff to say the least. Unpacking that further, essentially there's almost a divided audience right now that we're seeing among the banks and economists. One of, well, are we getting really close to what the bottom is going to be? Was that a big jump and now we're not going to see rates drop for quite some time as we wait for this to kick in? Or is this the beginning of a scary cycle where the BOC continues to cut rates because of outside influencers like, say, the governor of Canada, Trudeau, as Trudeau likes to call him, as Trump likes to call him, unfortunately dealing with a situation where Mr. Trump and his fun tariffs could spill over into 2025 and make 2025 more bullish than expected for rates. We'll see. And if we cannot avoid Trump's wrath, the economic damage can absolutely pound yields, which is obviously what impacts fixed interest rates, as we talked about before. And of course, the BOC would have no choice but to continue to reduce rates. Now, an interesting note on that is that BMO estimates that import export duties could boost the prices by a whopping 4.5%, which the Bank of Canada hints that it'll look through one-time price adjustments. But basically, all I'm trying to get to here without boring everybody is that more or less you're going to notice a situation where there could be a lot of volatility in the next 1 to 3 months as it relates to everything US and Canada. So stay tuned, buckle up your seatbelt. We'll see what happens. So where do we go to now? What is the market suggesting based on the information that it has right now? Now, we talked about the fact that rates could dive based on the tariff situation that could happen, or we've got these immigration cuts or a climb in our GDP. So if our GDP jumps up, it could beat inflation. There's so many different factors right now, and there's a massive amount of uncertainty, which is why we're looking at trying to understand our borrowers. And if you're a listener and you're trying to figure out how to make a financial decision to talk to somebody, to understand what makes more sense, whether we look at what we have in hand today for a 3, 4, 5 year fixed rate term or a variable rate or something closer to a hybrid, which I've spoken about in past episodes, which gives a borrower the ability to restructure their financings between a line of credit, a mortgage, or a variable rate mortgage with different terms in the ability to spread their risk. Not right for everybody, but a conversation worth considering. Now, on paper, if you're modeling out based on the projections right now, which I'll pull up on the map, it looks like today the BOC, based on the most recent outlook on the forward rate market, in a year from now we would be sitting at 2.75%, which is only a 0.5% reduction from where we are right now, which is why a lot of the market's saying, hey, we just saw our oversized rate cut. We're going to see this small cut and then some more afterwards. 2 years out, the market is suggesting we'd be sitting at 2.5%. And the market's obviously not very accurate 5 years out, but says you will be back at 2.5. So realistically speaking, if we end off at 2.25% over the next 1 to 2 years, we're landing pretty much exactly where many of the economists have been predicting. And without those extreme situations like CIBC suggested, it works out favorably for those who did take a variable rate in the past or potentially who are variable right now, which are sitting somewhere in the ballpark of the 5% range, because that would mean a 75 basis point to 1% rate drop, depending on where they're at right now in the overall market. Now, that's if you compare it against a fixed rate in the 4.5 to 4.75%. And if you're looking for a situation where you have flexibility and you have the ability to take advantage of the potential upside of rates coming down more than what was expected. So that's kind of a confusing and long way to basically say on paper the variable rates map out, but in reality, you need to understand your personal situation to be able to make a decision. Now, what does this mean as it relates to the real estate market? Now, two things to keep in mind. December 15th, we have a big rate change or rule change coming down the pipe. So by the time you're listening to this, it is already in effect. And that rule impact is the 30-year amortizations for insured mortgages for first-time buyers and all buyers on new development properties, and the ability to purchase with less than 20% down on a property up to $1.5 million. Big news indeed. A lot of thoughts and a lot of information. Now, the industry is on fire about what this rate cut will mean for the real estate market. Stats have shown that November had an exceptionally elevated real estate market, meaning we saw more transactions, specifically way more than we saw in 2023. And looking into 2024, we've seen an elevated amount of sales going across all the way into December, which is historically a very slow month in real estate outside of the 2021 to 2020 year, December winter. Most of the prognosticators and experts out there are suggesting that we see an early spring market that starts to favor sellers versus buyers. It doesn't necessarily mean that we're going to see multiple offers everywhere in every market. And in fact, I was reading an article from projections from Royal LePage. Phil Soper quoted saying that across the board meaning Canada, so not municipally, not city by city, but Canada wide, they see single family home prices going up 7%, and they see condo prices going up 3.5%. But that is city dependent and demand dependent on each town, and obviously how many developments are coming up in those particular areas. Now, if we continue to see the market move forward, I mean, first of all, before I even go there, I want to just talk about this rate cut and what it means for the marketplace. This rate cut is nothing more than a psychological, I guess, push to the marketplace for the average Canadian. Most average Canadians probably wouldn't be listening to this podcast because they're not the big nerds like you and I are. But at the end of the day, the average Canadian is not paying attention to what's happening in interest rates. And they know the BOC reduced rates, but they don't really understand that that's what impacts a variable rate or a floating rate and not fixed rates. And they can't qualify for more money. So the question mark for most Canadians at this point right now is, do I get back in the market? Mostly because more Canadians are getting back in the market and because costs are down. Now, we can't forget that about a year ago, so this time in 2023, real estate was exceptionally low on the back of fixed rates and variable rates in the sixes across the board. And now we sit here in the low fours and low fives, depending on if you're looking at a fixed and a variable interest rate. And that does have a notable impact on interest rates. And if you think back, last time we saw interest rates that were in those 2% and so forth was in the beginning of 2022. We're 2+ years away from that. You're going to get a series of people and a group of people that I wouldn't say forgot about these low interest rates, but it's just not top of mind anymore. And they're going to take what they have and they're going to pay what's out there. And when they see rates have come down across the board and they hear positivity, there's no doubt a lot of people will get back in the marketplace and pay what's out there. And a 4% rate could just be the new norm as it relates to the mortgage marketplace and what's going on right now. Now, overall, what is the market forecast? So I do want to talk briefly on what BMO forecasted again, because they were pretty vocal about it. The BOC, here's a quote from them. The BOC could very well cut rates a few more times, but another 50 basis points of easing by June is already priced in the marketplace. The spread between variable and fixed rates will continue to narrow, but given that we don't see too much more for the downside for 5-year yields, the low for mortgage rates in a well-behaved economy right now might be upon us, and that is somewhere in the low 4% range. So again, BMO is suggesting basically more or less the same thing. All right, enough of the BOC for a second. I think there's some real thoughts and impacts that we've talked about right there, but let's talk about the big news here today, which is, boom, the new mortgage rules, which we touched on just a minute ago, and what that means and what could happen. First of all, under the new criteria, a first-time home buyer, and you only have to have one mortgage applicant who is a first-time home buyer, can actually qualify for these 30-year amortization rules. And I do want to touch on the fact that one of the most common misconceptions that most Canadians make in the marketplace is the fact that you actually don't need to be a first-time buyer to put less than 20% down on a property. So let's separate the two. The 30-year amortization. Now, anybody buying a new development property who's putting down less than 20% can do 30 years. Any first-time buyer or mortgage application where one person is a first-time buyer can also do an insured 30-year amortization. Now, anybody putting 20% down or more can always do 30 years. That's an option that's just lender dependent, but generally across the board has been the case for a long time. Now, what constitutes a first-time buyer is what a lot of people are confused about and they're not sure about. I have posted a few videos about this on the YouTube channel and a few on the podcast, but I think it's important to remember that as part of the home buyers plan. So if you go to the Google or if you go to ChatGPT and you go look up the home buyers plan, you have access to a variety of different things. There could be RSPs, the first time home buyer savings plan, and there's different types of rules around what you can use and what you can't use and when you can use it when you're a first time buyer. A thing that a lot of people forget about is that if you are someone who's recently gone through a divorce, you are then allowed to participate in the first time home buyers plan again. So technically speaking, under the guidelines and the rules as it relates to the home buyers plan, if you qualify And whether you've just never bought a home before, or you have a written agreement to end a divorce, for example, you are qualified to essentially go through this home buyer's plan, which is pretty key and pretty important, which means there's quite a few people who have the ability to qualify for this program who might not have in the past. So, with that being said, what is the potential of the uptake on these programs? I mean, the 30-year amortization, I think, is going to be used widely. Between myself and a fence post, I would suggest that we're probably going to see a 75% uptake on the 30-year amortization rules. If for nothing else, the fact that people have the ability to not only qualify for about 8% more money, but they also have lower monthly payments. And the monthly payments are going to help them from a cash flow perspective, whether it's qualifying for a property at a higher price point, or let's say getting into the market earlier and then having extra cash flow to pay off a higher interest debt instead of paying off that money and waiting to save. So I think it just gets people into the marketplace faster than it would have otherwise. Now, I think there's going to be a lot of confusion and a lot of uncertainty as it relates to, do I need to be a first time buyer to qualify under the less than 20% down guidelines? And again, I will remind you, this is less than 20% down on anybody can do this. As long as you qualify under CMHC rules, you now, instead of putting $300,000 down on a home up to $1.5 million, you now can put up to $125,000. And the average Canadian is probably not going to do this, but where I think we'll see this most frequently will be co-buyers. So friend groups getting together, or families for that matter, families co-buying and moving into properties, particularly in the case where they might be doing an upsize. Another area where it would be, obviously we've got the new rules as it relates to being able to add rental suites to properties. Some incentives are available there. We'll do another podcast on that again in the future. But with the incentives, and then combine that with a 30-year amortization and the $1.5 million cap, again, you're going to see a lot of savvy quote unquote home hackers, or people that want to get in there, increase the value of their property, rent it out, or potentially just have a place where it can help them satisfy their lifestyle that they want to do. The second area that I think we're going to see more people qualify and use these particular programs is going to be those who are upsizing. So, I mean, for example, in the Fraser Valley, just outside of Vancouver, the average townhouse is $800,000 to $900,000. The average detached house is between $1.1 to $1.3 million, and that's an inexpensive house. So you'll see people that actually earn enough money to be able to make the payments, but they don't have enough equity because maybe they bought in 2022 or 2021, or maybe they've only got $100,000 after it's all said and done. Those people are going to be able to make that transition up to purchasing a property or home above $1 million, whether it's with a friend or by themselves. So a lot of interesting things that are going to come out from these particular new rules. I'd love to hear from you again in the comments below if you think there's another use case scenario that people will start looking at as it relates to the less than 20% down or the 30 years, or do you think a lot of people will use that? Now, looking at another consideration, looking into 2025, and we're going to talk about this as I do my next episode and last episode of the year, which will be on projections and predictions for 2025. I've got a list of potential predictions as it relates to mortgage rates and investments and what can happen in the marketplace. So don't miss that episode if you haven't already. It's going to be coming right before the new year as we take a break for Christmas. Now, with that all being said, of course, if you're liking the episode, if you're liking what you're listening to, I'd love a favor from you. Please rate and review us on iTunes, on Spotify, and of course, hit that like button if you're watching on YouTube. Leave me a comment, send me a DM. I'm the Mortgage Pug on Instagram or at Flow Mortgage Co. Appreciate you guys listening here today. Hope you found some value from the episode, and I'll see you on the next rate cut.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.